So in this example, we're going to look at some leverage effects that we talked about in chapter 12. So the main points here is that, first of all, leverage comes from having fixed costs, and these fixed costs can be related to operations or they can be related to financing. But the main point about leverage is that it amplifies the firm's cash flow risks, right? Amplifies the risk and return. So in particular, the sensitivity of the cash flow to shareholders. So we're going to continue the example from chapter 11, and about the Bluth's frozen banana stand. So Michael Bluth, who's the main character of the show Arrested Development, he's evaluating the finances of the banana stand, and in particular, he wants to calculate the break-even point. So how many bananas do they have to sell before they become profitable? 2, what is the degree of operating leverage? 3, what is the degree of financial leverage? And then lastly, 4, what is the degree of total leverage? So if you remember from the lecture, the break-even analysis is relatively simple as long as you have the fixed cost and the sales price and variable cost per banana. And so I'm providing the information for each of these. The sales price per banana is $10. The variable cost per banana is $3. So at the margin, they're making $7 per banana. But the banana stand also has a fixed cost per month of $5,000. So the question is, given this fixed cost, if they don't have any sales, then they're losing $5,000, each month automatically. So the question is, how many bananas do they have to sell before they become profitable? And it comes down to a fairly simple equation here, where all we have to do is throw in the numbers, and it gives us Q, which is the number of bananas, right? So it's $5,000 divided by 10 minus 3, or 7. And that gives us 714. So that means that the banana stand has to sell 714 bananas every month just to start, just to break even, right? To start becoming profitable. And, so that's about 24 bananas per day. So, as an extension to this, Michael is one option available to him is that he can reduce the fixed cost of $4,000, but by increasing the variable cost per banana to $350. So one question is, does that increase or decrease his break-even point? And so really all we have to do is plug in the new numbers and to find the new Q, which is 4,000 divided by 10 minus 350 equals 615 bananas per month. And so, because 615 is less than 714, then this means it would reduce his break-even point. Okay, so one question is, how much operating leverage is there in the banana stand currently? And if, as you recall, the operating leverage, the definition of it is the relationship between sales and EBIT, right? So let's say that banana sales are currently $2,000 per month. And if that's the case, then the banana stand is generating $2,000 times $10 equals $20,000 per month in sales, $5,000 in fixed operating costs that we've already established, and $2,000 times 3, which is $6,000 per month, in variable costs. So EBIT for the banana stand currently is $20,000 minus $5,000 minus $6,000 equals $9,000 per month. So to figure out the degree of operating leverage, what we're trying to do is figure out, how much does EBIT change for a given change in sales? So let's say, what if sales increase by 50%? How much would EBIT increase? Would it be more or less than 50%, right? So that would mean sales increase from 2,000 to 3,000. That means sales now are 3,000 times 10 equals 30,000 per month. Fixed costs are the same at 5,000. Variable costs change, 3,000 times 3 equals 9,000 per month. So EBIT changes to 30,000 minus 5 minus 9 equals 16,000 per month. So compared to before at 9,000 per month, that's a 77% increase in EBIT. So the degree of, the degree of operating leverage is 1.54, which is simply 77% divided by 50%. Now there's an easy way of doing this, which is using this formula right here, right? So all we do is plug in the numbers, the amount of sales, which was 2,000, sales price minus variable cost, fill in the rest of the formula, you get 1.55, right? So what this means is that for every 1% change in sales, EBIT is going to change by 1.55%. Okay. We can also compute the degree of financial leverage. And as you recall, the financial leverage is the relationship between EPS and EBIT. So we're going a little bit farther down the income statement. Basically, we're taking into account loan payments and taxes. So let's say to build the banana stand, Michael issued debt and currently has monthly interest payments of $2,500. And let's say the tax rate is $40,000 and there are 1,000 shares outstanding. What is the degree of financial leverage? Well, start with EBIT of $9,000 per month. We subtract out the interest payment, which is tax deductible. And so we take 9,000 minus 2,500 to get taxable amount. Multiply that by the tax rate, and that gives us 2,600. So earnings are the 9,000 in EBIT minus $2,500 interest payment minus $2,600 tax payment, and that equals $3,900. That's earnings available to shareholders. We divide that amount by the number of shares, and we get an amount per share, which is $3.90 per share. So to figure out the degree of financial leverage, the question is, if EBIT increased by, say, 50%, how much does the EPS change? Is it more than 50%? How much more? And so a 50% increase in EBIT would move it from 9,000 to 13,500. So we just plug in the numbers again. EBIT is 13,500. Interest payment is the same at 2,500. Taxes change from 13,500 minus 2,500 multiplied by 40%. That gives us a tax bill of 4,400. So earnings available to shareholders would be 13,500 in EBIT minus 2,500 in interest payment minus 4,400 in tax payment, and that gives us $6,600 in earnings to shareholders. EPS then is that 6,600 divided by 1,000, 660 per share, and so EPS then increased by 69%, right? Because 660 is 69% higher than 390. So the degree of financial leverage in this case is 69%, the amount that EPS changed, divided by 50%, the amount that EBIT changed. And that gives us 1.38. Now, there is an easier way to do this, which is using this formula directly. So we just input the information here into the formula, and we get 1.38, right? The same amount as doing this exercise. And the degree of total leverage, so 1.38, that means for every 1% increase in EBIT, EPS is changing by 1.38%. Now the degree of total leverage is going to be the degree of operating leverage and the degree of financial leverage multiplied together. So 1.55 multiplied by 1.38 equals 2.14. And so what this means is that for every 1% increase in sales, EPS will increase by 2.14%. So you can see that EPS, the change in EPS, is magnified by this leverage effect, which is all due to having fixed costs in operations and financing.